All right, welcome to another video on cost behavior, and some of our concepts that we're going to be looking at in this video would require, notice we're starting here on number 16. So that means we had, I think the first 4 questions of this little handout were actually dealing with the differences between financial and managerial accounting, but that still leaves questions 5 through 15 as being important and in many ways being a prerequisite for understanding what we are talking about here. So I don't like to use the term advanced, but as far as understanding cost behavior is concerned, a lot of what we're going to be talking about in this video will pertain to information that is covered in prior videos. Okay. All right. So question 16 is actually a review. It says costs incurred because the relevant range has been exceeded are called. Okay. So in order to answer this question, we have to first understand what relevant range is. And relevant range is basically a somewhat normal range of operating activity. So when we think about probably a production environment, we can say, okay, that certain types of costs are going to be the same. But I want you to think about a situation where you've got 75 employees for just a moment, okay? And let's just say that you have a period of low activity. So we're going to label this low, normal, and high. Okay? And let's say that we normally have somewhere between 70 and 80 employees. Okay. When we have low levels of production in our facility, we may have something like 40 to 69 employees around. When we have high activity, we have somewhere between 81 and 99 employees. And when we have 99 employees, working, it gets a bit cramped. So now let's say that we want to hire a total 200 employees. Okay, so this is far beyond our maximum capacity of 99 employees working either in a shift or across all shifts, whatever the case may be. And so in order to get 200, we're going to have to basically double our facility size. All right, so we're not really talking here about variable costs of hiring these employees, these additional 101 employees. What we're talking about here is additional factory, facilities, machinery. It depends on what we're doing in our business, but we call these step costs. Okay, and normally step costs are also fixed cost, but the difference is that they are incurred. They are incurred because of a change in capacity. We have exceeded the range of normal operating capacity, and as such we incur step costs. Step costs are usually fixed. They can be variable, and if that's true, they could also be mixed, right? So you're like, well, all of these answers are true. Well, not exactly, because we're talking about costs that are incurred specifically because we have exceeded relevant range. If you don't know what that means, I've explained it, but make sure you review it. We call that a step cost. And again, this is something that we would have discussed in a prior video. So in that regard, it is a bit of a review. All right. Question 17 says, when a company chooses to produce one additional unit, what type of cost is incurred? Okay, one additional unit. All right. Well, it wouldn't be a step cost because we have to exceed relevant range for that. And so the term that we are looking for here is marginal. Marginal. And whenever we use the word marginal in business, heck, whenever we use the word marginal in taxes, you might hear of somebody's marginal income tax rate. That refers to the highest income tax rate that they are taxed, and that would be essentially on the last dollar or several of the last dollars of earnings that push them into that new tax rate. Okay, so if you don't like taxes, then you can just recall that whenever we choose to make an additional unit, we call that a marginal cost. We do not incur that cost if we choose not to produce the one additional unit. Okay, now I want you to think about that, and then I want you to look at this question number 18, and this is kind of for a true-false question. This is fairly difficult. It says marginal costs generally refer to variable costs because fixed costs are going to occur anyway. Now the way that reads, if I was a student and I wasn't really familiar with this, I would say, okay, the way this reads, it sounds false. This is actually a true statement. This is a true statement. Yes, making that additional unit, as we've discussed in previous videos, the concept of fixed cost per unit. When we make this additional or marginal item here, our fixed cost is going to go down on a per unit basis. Our fixed cost per unit will go down. So and this is again some review, as activity goes up, fixed cost per unit goes down. However, fixed costs in total do not change, again within the relevant range up here. So these marginal costs generally do refer to variable cost. All right, so marginal costs are not the same thing as variable cost, but a marginal cost is a variable cost. Okay, but not all variable costs are marginal. Okay, so that's why we can't use those as synonyms. Question 19 says, as volume increases, which of the following statements is not correct? This is an exceptionally difficult multiple choice question. And so when you have something like this that says that it's not correct, make sure you always pay attention to that because it won't always be italicized. So make sure you read the question carefully. But that also means that 3 of the answer choices are going to be true. Okay? Variable cost per unit will remain the same. Under normal circumstances, this is a true statement. So if you recall from previous videos, we said that, with variable cost, the per unit amount stays the same, but the total amount is what changes as we increase production. So A is not going to be right. Total fixed cost will remain the same. This is also a true statement. Okay, so as volume increases, fixed cost per unit goes down, but the total fixed cost stays the same. So variable and fixed costs behave differently, in fact opposite. Okay, cost per unit will increase. This is going to be our answer. Now I did not write this question So I would have probably worded it slightly differently had I written it. But what we're talking about is the full cost per unit, okay? And because we have a fixed cost component in the total cost per unit, this rule right here applies. As volume increases, fixed cost per unit goes down. Now that doesn't have any impact on the variable cost per unit because we already said that the variable cost per unit stays the same. But this is not a true statement because of the fixed cost component of whatever it is we are making. And then let's see here. Total variable cost will increase. Well, that's obviously true. So D is that's the one that we have to know that we cannot select. Okay. All right. Do reach out to me if you have any issues with any of these questions. Otherwise, do your own independent research as to why the answer is what it is. These are, again, when we start getting into cost behavior, don't sleep on this as a topic. It can be very, very difficult. All right, question number 20 says, consider the answers for question 19 above. Okay. Recognize that an assumption is being made regarding two of the incorrect answers as well as the correct answer. What is it? Okay, and so I want to give you the answer first. The assumption is we are operating within relevant or normal range. That's the assumption. Now that does not apply to answer choice D, okay? But here's the thing. Let's look first of all at answer choice C, which was our correct answer. And we would say that that's not true. Cost per unit will actually not increase, it will go down. But if we exceed relevant range, okay, then fixed costs go up. So this right here is no longer holds true. Okay, now depending on how much fixed costs go up, how much we increase activity, the fixed cost per unit still might go down, right? If we have just a small increase in fixed costs and a massive increase in volume, okay? But that is an assumption that we are making with this, is that we are operating within the relevant range. Answer choice B, total fixed costs will remain the same. It's the exact same thing. Total fixed costs will remain the same only if we stay within relevant range, okay? And then answer choice A says variable cost per unit will remain the same. Well, that's not necessarily true. Think about payroll for just a moment. If we start to really, really ramp up our volume, we could have a situation where we have a large number of employees who are earning overtime. And if that happens, variable cost per unit could change because we didn't go out and hire new employees, but we're paying the ones that we have a higher average rate. So that's just one example. Again, on D, total variable cost should increase anytime volume increases. So that's the obvious incorrect answer on 19. So make sure we understand that we were making an assumption on 3 of those 4 choices. Okay, and then 21 says, why do average costs, this will be the last one we do, why do average costs decrease with increased production? Because fixed costs do not change. Because fixed costs do not change within the relevant range. And it says, why do average costs increase with decreased production? Because fixed costs do not change within the relevant range. In other words, if we reduce our production, decrease it, we are just merely assigning those fixed costs which do not change in total to a smaller number of production. Production increases, again, within the relevant range. We get to assign those fixed costs in total to an increased amount of production, and so average cost will decrease. All right, this video is way too long. Let's wrap it up.